Hello, and welcome to the Opus Wealth Management 2025 Markets Outlook and Portfolio Discussion. I'm Aaron Whalen, and with me today are portfolio managers Louis Odette and Mark Duvall. We'll start looking back. Much easier to discuss what happened in the past than conjecture on what may happen in the future. AI, the acceleration of AI as a focus for investors was, of course, a key theme, as well as, and understandably, concern about interest rates and what is the Fed and other central banks doing in terms of interest rate policy. Starting with you, Mark, can you just give some perspective of what we saw last year and what you saw as kind of the key things that you were both following as you were tracking the markets?
Yeah, I mean, in the fourth quarter, obviously we had the election and there was a lot of volatility, a lot of shifting around occurring, and netted out, U.S. stocks were up a couple of percent because the dollar went up and there was concerns about, what might happen with tariffs and all these other things. Then non-U.S. stocks were down about 8%. And because there was a little bit of a rise or fear, there was a rise in interest rates and a fear that, some of these policies might be inflationary, therefore bonds gave up about 3%. Now, that was just the fourth quarter. When you extend out over the full year, large U.S. stocks were up 25%. For the second year in a row, they were up over 20%, a very nice market. And even mid and small caps were up double digits. Mm-hmm. Developed international, relatively modest returns at 4%. Emerging markets at 7.5% is pretty good. U.S. bonds did have a positive return. They didn't earn all of their income, which is actually sitting at a pretty decent level right now because of the rising interest rates environment that kind of occurred towards the end of last year. And then there was some losses in non-U.S. bonds, mainly because of the rise in the dollar.
The currency component.
Yeah. Exactly. And now there's divergence that we're seeing globally. The U.S. economy's been doing pretty well. And that looks like it's set to kind of continue. At the same time, we're also seeing divergence in central bank policies. So the U.S. is, started on a downward interest rate environment, but it's not going as fast as what's going on in Europe. And Japan's actually starting to raise rates a little bit. And so we'll have to see how this all plays out relative to earnings and the fundamentals for companies and markets as we then kind of play out through 2025.
So looking forward, the number one question that I think we're all getting appropriately in client meetings is, now that the election has passed, and now that we're starting to get some visibility in terms of the more immediate actions and priorities of the new administration, could you speak a little bit, not going to hold you to this come December 31st, I promise you, but I know you've done both a lot of work in trying to analyze what's going on here. What are some of the impacts that you see coming into the new administration?
Yeah, a lot of the policy specifics remain forthcoming, so we don't have all the details to analyze that side of things quite yet. I do think it's probably a safe assumption that the actual implementation will be a bit more measured than some of the rhetoric that we saw on the campaign trail. And I think there are four main areas of focus that the administration will prioritize. So that's trade, immigration, tax, and deregulation. And so the first two of those should probably be inflationary relative to another outcome because it'll shrink the labor force and also add some frictions for imported goods. And then the second two, lower taxes and deregulation, those remove frictions from the economy. And so those should be pro-growth. So I think that we're likely to see higher growth and higher inflation relative to what we might have seen under a different outcome.
Do you think that's part of why we've seen the tempering in terms of rate cut expectations over the course of the last, market basically pricing that in?
Yeah. I think the Fed would probably not acknowledge that.
Of course not. It's an apolitical,
But yes, I think they are factoring that outlook into their decision making.
Got it. So feeding it really, Mark, on the comments you made in terms of looking back, a lot of those themes, some that played out last year, some that have been playing out going back to the financial crisis, looking into the next year, in addition to the political aspects that Louis was discussing, what are the other things that you're looking at in terms of how you're analyzing outcomes for the coming year?
Yeah, I mean, there's mixed signals we're getting from the U.S. stock market because on one hand, momentum's been very strong and you're seeing, large returns. At the same time, valuations, particularly in the large cap space, are getting a little bit stretched. And that's been because of AI. There's been a lot of investment into AI. Yes, that's shown up in data centers and electricity demand, but it's also then, large amounts of CapEx from the largest companies in the world in general that are within the United States. And that's led to their valuations being a little bit high. Now, interestingly, most recently with the DeepSeek AI out of China, all of a sudden it's maybe there's not such a great return on all that investment. And, the company that had benefited the most, Bay Area-based NVIDIA, which at one point had the largest market capitalization, well, on January 27th, it actually lost 18% of its value in one day. And it's been volatile around ever since.
And that was, by the way, wasn't that the single biggest erosion of market cap in the history of the stock market?
Exactly. Yeah. I mean, it does help when you start from a very
A
large
hard
number.
base, yes, for sure.
But and so I think a lot of how that, we don't know exactly how that's going to be playing out, but we do anticipate that that when you've got momentum that's been going in one direction, it can go the other direction, and you want to pay attention to valuations and diversification. Another major topic is just kind of how strong will employment remain? And on the margins, maybe we're going to see a little bit less government employment and a little bit more private sector employment. But thus far, we've seen a really strong employment market in the United States for a number of years. And then to your comment earlier on about the Federal Reserve and interest rates, they're very data dependent. And, they've kind of said, well, we're pausing for right now for a lot of these various reasons, and they're looking for, is inflation really going to be coming down towards their target? Is employment going to remain strong or not? And then, those are going to get influenced by to what degree do we see tariffs? To what degree do we see immigration being impacted or people being deported from this country?
So tying your comments together in terms of what we saw in 2024, what we see potentially in 2025, for you, Louis, really a two-pronged question. One is what happened with portfolios given the backdrop of last year? And then also, what do we see going forward this year in terms of specific changes that we may be either actioning currently or thinking through as we're going into the first quarter of the year?
Yeah, in terms of the performance of client portfolios in 2024, returns were positive across the risk spectrum given the strength in the stock market and certain areas of alternatives, despite muted returns for bonds. And some of our most aggressive allocations posted double-digit returns for the year. So looking ahead to how we'll rebalance against that backdrop, our typical practice is to have a discipline of buying low and selling high. So we'll typically trim things that have outperformed and add to things that have underperformed, given the idea that performance should mean revert through time. And we're still going to do that this year, but we're shifting our targets a little bit to dampen the magnitude of that change. And tax considerations are a big part of the rationale for doing that. And then within the stock market, given the economic decoupling that Mark described earlier, we're shifting a little bit of our allocation out of foreign stocks and putting that into U.S. stocks. And the area that we're targeting within the U.S. stock market is the mid-cap arena. And that's because it has higher domestic revenues and more reasonable valuations than large companies, but also better quality in terms of profitability and balance sheets than small companies, while still benefiting from a food chain type effect if we do see an uptick in M&A. So for all those reasons, we think mid-caps are the most attractive area of the U.S. markets.
Well, thank you both, as always, for sharing your perspective. And thank you to everyone that joined us. We look forward to our meetings with you in the coming quarters and encourage you to reach out to your wealth advisor with any questions.